Welcome to TheoTrade. This is Don Kaufman. It's October 2nd, 2019, and you are watching the TheoTrade evening video. There's about 10 minutes to go into the cash close. The S&Ps are currently down 51 and change, but I got to tell you, there's some strong sell side activity coming into this cash close. Oh, it does appear that we're going to be reaching for the session low, 28.74. Hey, and then some. Listen, the sellers, they're here. They have arrived. Let me break down some of what you're seeing inside of the last two trading sessions, which have really now just kicked off some strong sell side activity. And then we're going to position ourselves for what to anticipate the remainder of this week. And I got to just throw this out here right up front. Tomorrow, that is Thursday, okay, October 3rd, it could just get downright wild. If you're curious, and again, I'm just going to kind of foreshadow for a second, it's all about what's on the calendar. Factory orders, ISM non-manufacturing. I mean, it was yesterday's numbers that really sparked sell-side activity. You get a rough number out of the factory orders or a rough number out of ISM non-manufacturing, people, we're going to be in downright trouble in tomorrow's session. Before I get back over to that, let's start with a point that I was making on this weekend's video. And for those of you, if you missed this past weekend's video, I am telling you, go back, listen to it. It's not often that I say that, listen to it, because many of the points that we made and we saw last Friday, okay, resonate inside of today's trade. In fact, I even have a little scratch pad of some of those points, and we're going to kind of hammer a few of those home. You know, but the weekend video was called On the Verge of Volatility. Clearly, we're seeing some volatility. But one of the most important ideas that we're seeing right here, right now, was this: correlation is a dangerous idea. And I want to reiterate something because, again, that's the point to be taken from this. We are currently in a completely correlated state, right? It doesn't get, more correlated than effectively. What are we seeing? This is the quintessential, like, all down day. This is the S&P 100. There's no place to run, no place to hide. Obviously, people are going to look and say, but there's 3 stocks up. Listen, there's going to be news from time to time on individual products, but that's what correlation is about. There's no place to run to. There's no place to hide. Every asset class across the board, okay, is playing into this. The other point that I want to make that was also made on this past weekend's video, bonds, well, they're poised to drive the next equity move. What do you think we're seeing right now? Okay, the bonds, right? They're not exactly exploding to the upside, but there's the move. Okay, we had bonds positioned right between the 161 and 162. The second they started to break to the upside, people, it was over for the financials. And the financials are literally feeling the brunt of that. Again, these are all points that we were hammering home. Financials are holding together in the entire S&P 500. Well, guess what? Here's your financials. This is just, 3 days later, they're getting decimated. Consumer staples, okay, XLY. In fact, one of the things I want to bring up, what has been incredibly docile as of late, has been the consumer staples. Nothing has touched the consumer staples, of course, until really today's trading session, when consumer staples, including Walmart, of course, are coming apart, as I said, at the seams. Nowhere to run to other than what? Maybe we have Costco. But this has earnings, so we exclude it for the time being, just to the sheer respect that it has an earnings announcement on it. So as I was saying, you kind of have this feeling right now, well, there's nowhere to hide. Oh, listen, before you get and take that too far, we're going to take a highly detailed look at the SPX, because I don't want to leave you with the impression that there's nothing but downside from here. Clearly, I am concerned about some of the economic news that is going to be out on Thursday. Now, and a lot of people, they're looking at this and saying, no, it's going to be the jobs report on Friday. Forget about that. You got to get through ISM non-manufacturing. You got to get through factory orders before you even get to the jobs report on Friday. Okay, so push that aside. One of the things that you absolutely need to respect right now, okay, is that we have an expected move onto which we have already crossed outside, okay, the bottom of it. What this means at this point in time is that trade is going to hedge with the dynamics of the marketplace. Okay, to kind of explain this a little bit, once we're outside this line, and that line, okay, it's our Maginot line over here. Once we're outside of it, what does that line represent? It's not like an imaginary, fictitious 618, Fibonacci over there. That line is definitive. It has everything to do with firms that have huge positions on, okay? And what occurs is once you cross outside of it, they have to sell in order to reduce risk. What happens is once you start crossing outside of it, these traders have what we term positive delta on. To offset their positive delta, they must add negative delta. How do they add negative delta? By selling. By selling what? S&P futures. Why do they sell S&P futures? Because they're trying to hedge SPX options positions. All right? And this is, some people, again, will call it dynamic hedging, which it absolutely is. Others will actually call it the negative gamma trade. It also is the negative gamma trade, okay? But again, crossing outside that kind of weekly expected move, it kicks those hedging devices into full gear. So if you see on Thursday, if we're able to rally back up and catch the edge, all right, of the expected move, hey, all will be forgotten. We're going to hold on, okay, like grim death to the edge of the expected move. But the problem that you've got is you've got these factory orders, this ISM coming out, and you're already outside of it. And I'm telling you, okay, albeit there's a small probability of this, this is where things can just get downright hideous, okay? And I'm not in this case, I'm not sitting here saying we're going to get downright ugly. Listen, we know the sellers, they've arrived. Their sell side activity. Are they actually just going to take it and run with it? Well, that's going to be based, a huge amount of it anyway, on what these ISM numbers. And I hate to leave you in that kind of like lurch because you're a coin flip away of seeing a very hideous move to the downside. How hideous? Okay. See, in a situation, right, where you've got markets making some fairly drastic moves, all you have to go on are these gravity points. If we're going to sell off, if things are going to get, downright ugly, now you've got a number to put to ugly. Ugly equals 2842. At least it would be a stopping point. It's like checking a box on the way down. There's your box, okay, to turn around and kind of check that off on the way down. It's 2842 is one of our gravity points. If we're going to rally back, sure, you'll see 2911. But make no two ways about it. We are trapped right now, okay, like a rat in a cage. We are back inside of this volatility channel. We've actually termed it the volatility box, or what I sometimes call it, the hurt locker. This is a move that we've seen consistently, okay, in some of the previous weeks from 29.11 down to 28.42 and back again. Again, let's assume that those ISM numbers come out. The market doesn't like it. We're going to rock it down to 28.42. Check that box. Then and only then, okay, are you going to be able to breathe a little bit of a sigh of relief. Now, let's kind of continue from there. So back over to the SPX. I wanted to throw out some levels. I wanted you to look at the SPX, but back to the SPX. One of the things that you also have to respect between now and Friday. Listen, there's no Thursday expiration, so we got to go off Friday expiration. You are sitting right now on just about another $40 expected move. I think the irony of that $40 expected move is it takes us pretty much precisely to none other than what? Well, what's $40 below where we're currently at? Oh, I don't know, about 28.42. Close enough, right? I mean, it's again, that's shouldn't be like awe-inspiring. It's just simple math, and the expected move has us priced for the capability of moving all the way down to that 28.42. Again, There's the closing bell. That target to the upside is about 29.11. Now, let's not talk too much about individual stocks, because quite frankly, as I mentioned a moment ago, it doesn't matter. Okay, where are you going to go? Where are you going to go with individual stocks? All that you have to look forward to right now is high correlation, the fact that we have a binary number coming out, it's factory orders, ISM, okay? And again, that's what we have to go on right now. Now, from a sector by sector standpoint, they're all getting tagged. You want to look at hideous? Go take a look at something like XLV. This is healthcare just over the last couple of trading sessions, downright hideous. This is one, again, not only is it seeing sell side in the last 2 days, but this is starting to become, as I said, kind of downright hideous. It's only up as a sector now 3% on a year-to-date basis. I'm going to come back to why here in just a second. Now, continuing on over here, if you take a look at the financials, XLF up about, 11 and change. Then we start looking at stuff like XLU, which has been highly defensive, still up 22%. Why am I bringing this up? Because I want you to see that the spiders are still up 15% on a year-to-date basis, even after taking a fairly substantial hit in the last 2 trading sessions. Why do I bother mentioning it? Because I want you to go through and I want you to look at some of the individual sectors. Because there, people, there's going to be your opportunity. And I'll reiterate once again, look at stuff like XLU. Why? Almost completely and totally unscathed as of recently, up 22%. You could look at something like XLY, which is consumer discretionary. Well, this is already taking a little bit of a hit. I would probably exclude it for right now. Obviously, as I was saying a moment ago, XLV, that's just getting downright hammered. It looks and appears like XLU, which is utilities, and XLP, which of course is consumer discretionary, are the places that you're going to want to focus on. They're precisely, okay, the ideas that we were throwing out in this past weekend's video. Keep an eye on them, again, as the days go. By the way, one more I'll throw in there too. Have an eye and positions, specifically on XHB. The last 2 days has been rough. Nevertheless, do you realize the home builders are still up 30%. Some of those economic numbers come out, start to rock the markets. Okay, I'll tell you what, the XHB is going to pay to the downside. Again, sellers, they've arrived. Thanks everybody for joining us here at TheoTrade. Have a wonderful evening. Bye-bye.